I welcome you to the third lecture in the fourth module, Valuation of Equity Shares. Here we would be discussing the free cash flow model. So the flow of the presentation would be first we'll try to understand what free cash flow is, what are the different types of free cash flow, and the evaluation model and discount rate and other things which is part of identifying and understanding about free cash flow. So what do you mean by free cash flow? So free cash flow is representing that portion of money which the company has generated, which goes to the investors. So as the name suggests, it is free cash. So which means the company has generated cash, it is free to be shared among the investors. That's the meaning of it in simple language. Okay, and it can be available for distribution to investors, or if suppose the company feels that there is more growth potential in the company by means of reinvesting this particular amount, then I can use it for additional capital expenditure. And in this case, this is called plowing back of profit. Okay, so I'm going to not distribute it in the form of dividends or anything. What I'm trying to do is I'm going to retain this particular amount in the company for further capital expenditures, and I'm going to grow this money back and give it to the investors in future. So that is why it's called plowing back of profit. And this indicates the company's ability to generate cash, and which can be either used for paying dividends or for repurchase of shares or reinvestment in business. So these are the three conditions for which it can be used. So one, I told you, cash generated which is available for distribution to investors is nothing but your dividends. The second is capital expenditure. It is reinvestment in the business. Here, there is a new term which we have introduced. It is share repurchase. It is otherwise called buyback of shares. So when do companies go in for buyback of shares? See, let us assume that the company has issued 10,000 shares of 10 rupees each. Okay, and the company is having enough profit, but it is not having any avenue to reinvest in the company because they feel that the growth factor is stagnant at a particular point of time. Now, what the company will do is they can use this excess money which they have generated to buy back the shares. They say that I am ready to purchase back shares from the existing shareholders, that is 10,000 shareholders, which you have purchased at 10 rupees. Might be I am going to purchase it at 12 rupees. Whoever is interested can give me the share at 12 rupees. So there could be individuals who are ready to give back the shares to the company at a higher rate than what is available in the market. So this is called buyback of shares. So free cash flow is those cash which is generated by the company, and it can be used for either paying dividend or for increasing the capacity of the company if the business prospect is there, or you are going to invest in another wing of a company which is going to produce a totally different product, diversified product. You can invest in it, or I'm going to repurchase the shares from the existing shareholders. So this is what for which free cash flow is used. What are the different types of free cash flow? There are two basic types of free cash flow. One is the cash flow to the firm, and the second one is cash flow to equity. So what do you mean by cash flow to the firm? So cash flow to the firm means this money is there with the company itself. So it means to say that it is available to all the investors, right? And this can be used either for repaying the debt or purchasing the equity shares back. Okay, so this is the money which the company has generated by means of its normal operations, and it would be used this is calculated after covering all capital expenditures or any working capital requirements which the company has. So after meeting out all these expenses, whatever is left out with the company can be used either to pay back the debt or buy back the equity shares. So that is free cash flow to firm. Second is free cash flow to equity. So what do you mean by free cash flow to equity? This is the cash flow which is available to the equity shareholders. And what is the amount which will be available to equity shareholders after you have made all the payments to the debt holders, and I can also include the preference shareholders. So after paying them all these, the debt holders and preference shareholders, whatever amount is left is considered to be the free cash flow to equity. And as the name suggests, it is the fund which is left after the operating expenses, after meeting the interest payments and the capital expenditure. And probably you can also include the preference dividend over here. If suppose it is a redeemable preference share. So let us go into a little bit depth of free cash flow to the firm. So as I told you in the earlier slide, it is the capital cash flow is available to all the capital providers. Who are the capital providers? Capital can come into the company either in the form of debt or in the form of equity. So this money is equally available to both these individuals, and the excess cash whatever you are going to have which can be shared among these two is because of the company's performance, and you can use it either for reinvestment purpose also. Okay, so how do I calculate the free cash flow to the firm? It is nothing but EBIT. EBIT is what? Earnings before for interest and tax, right? So earnings before interest and tax is EBIT into 1 minus tax rate. What do you mean by this 1 minus tax rate? Because the interest whatever I am going to pay is tax exempted. It is considered as an expense. It's not part of the total income, right? So this earning includes interest and tax. Okay, it is before the payment of interest and tax. So which means I'm going to get the benefit of tax for the interest I'm going to pay. So that's why I put it as 1 minus T. Plus, there are other expenses which is shown in the financial statement, but in real term it is not an expense. For example, depreciation. So depreciation is, I've purchased an asset at 1 lakh rupees, and I told you I follow a straight line method of depreciation of 10%. So which means at the end of first year, the value of the asset is going to become 1000 less so it becomes 99,000, right? So this 1,000, I am showing it as an expense, and it is, the expense name is depreciation. So in real terms, this money is not going out of the company, but since I have shown it as an expense, my actual cash flow is more than the what EBIT is reflecting. So that is why I am adding back depreciation. There are certain items which I have considered as income, but in real terms, it is not a income. For example, capital expenditure, right? Capital expenditure and change in working capital. These are two things which is going to add value to the firm in total. So though I have shown this as a spending or an income, it doesn't actually mean that it is going out of the company. It is reflected either in the form of an asset or it is reflected in the form of a current asset, fixed asset and current asset, and that's the reason why we are adding it back. So let us take each thing separately. EBIT, as I told you, it's earnings before interest and tax, and it is nothing but it's the company's operating earnings by means of its operations. Whatever you have earned is called EBIT. 1 minus tax rate, it is the adjustment for the tax, and we are more interested in finding out the after tax cash flow. So whatever taxes has to be paid, it is considered over there. Depreciation, it is added back because it is a non-cash expense. Capital expenditure, it is subtracted as these are cash outflows for normal operations or expanding the operations. And change in working capital, short-term asset, and it is impacting the cash flow in terms of liabilities also. And I'm talking about short-term assets, short-term liabilities will also be part of its reflection. The second type of free cash flow which we have over here is free cash flow to equity. So what does this mean? It means to say that this particular cash is available to equity shareholders. So when does the equity shareholders get this money? After you have met all the expenses, after you have paid the tax, after you have paid the debt, whatever you had, and you have met the capital expenditure. And it gives a clear picture in the mind of equity shareholders, equity investors, because there is all the things are clearly settled, and whatever is left out is for the equity shareholders. So how do I calculate it? It is free cash flow to the firm minus interest into 1 minus tax rate. So minus interest is because I am going to pay the debt, repayment of debt, plus the total net borrowings. I'll talk in detail over here. Interest into 1 minus tax rate is nothing but the tax rate, interest paid to debt holders, right? I told you interest is paid to the debt holders and it is exempted from tax. And net borrowings, it reflects the cash inflow from new debt minus any repayments which you have to do, right? And whatever is left out is for the equity shareholders. So that's what I mean by free cash flow to equity holders. Now, free cash flow valuation models, there are different valuation models as you have seen in the previous lecture. The similar type of valuation models you have, and here you have the free cash flow model as projected free cash flow which the company is required to find out, and it is normally going to use the discounted cash flow method so that you get the present value of future cash inflow. So it's a continuation of whatever we have seen in the previous lecture, which talks about discounted cash flow approach. So discounted cash flow approach on what? On the free cash flow model. Okay, so by going in for the discounted cash flow approach on the free cash flow, you are trying to project the future cash flows by discounting it to find out the present value. So if suppose I am saying that the free cash flow to the firm is 1 lakh at the end of 1 year, right? So it means to say that this 1 lakh will come after the 1 year. I am trying to find out its current value after projecting all the expenses whichever is to be deducted, right? And why do I discount free cash flow? I discount free cash flow to find out the present value, because as I told you earlier that the money in your hand today is worth more than its value which you would be getting tomorrow. Why? Because you have something called opportunity cost and there's something called inflation which is existing in the market. So opportunity cost is by means of withholding the money for 1 year period, you might be compromising on certain things. So that is part of your opportunity cost. And inflation, because of price level changes happening in the market, the purchasing power or the current cost accounting would be different. So I'm not going into details of that. So because of the change in the purchasing power, there is a need for us to go in for free cash flow, for discounting free cash flow. Okay, and the discounted rate of free cash flow, how do I determine? The discounted rate of free cash flow can be determined by either using weighted average cost of capital. So weighted average cost of capital, what do you mean by it? It is based upon the proportion or proportion of various funding in business. So let us assume what are the different funding in business. You have equity shares, you have preference shares, you have long-term debt. Let us assume these are the three major things. And in weighted average cost of capital, what does it mean? First thing, you should understand cost of capital, right? What do you mean by cost of capital? For any type of capital fund, whatever is there, this has a cost. Why this has a cost? Because equity shareholders are giving money to the company with the expectation to get certain amount of return, right? So that is why this has a cost. Preference share, again shareholders are giving money to the company because they expect some return they require, and that is the cost of preference share. Similarly, debentures or debt, they also have a cost, right? So if suppose I am going to divide this in terms of cost, weighted average cost, then I am going to give weightage for each and every things. Let us see how we will be doing it. Okay, the weighted average reflects the required rate of both equity and debt holders. So let us assume that the equity shareholders is expecting 14% return, preference shareholders is expecting 10%, and debt shareholders are expecting 8%. Okay, so this is the first criteria, that each and every individual who's participating in the fund allocation is going to is having certain expectations in terms of return. And what I'm trying to do, I'm trying to make suitable cash flow available to all investors. So what I'm trying to do is 20% will be equity, right? 30% would be preference, and 50% would be debt. So this is how I try to find out the proportion of the different types of funding which is available. Why 20% of equity? Because this is the most costly. I do not want, if I'm going to spend more on this, my free cash flow is going to be lesser, right? I would increase this because the cost to the company is going to be lesser in comparison to this. Again, more in this because the cost is going to be less for the company in comparison to the others. So this is how we have done. Okay. So you can either use weighted average cost of capital as the rate of return which is expected. That's one thing. Second is discounted cash flow for equity is the cost of equity is used as the discounted rate, okay, for valuing the equity investors. So under two conditions, first condition is free cash flow to equity. I'm going to use the cost of equity as the discounting rate, and in free cash flow to firm, I'm going to use weighted average cost of capital as the discounting rate in order to find out the rate of return, okay, a discounted rate of cash flow. And what is the correct discount rate? How do I select? It is very difficult to say because it's not always possible for us to pinpoint and say this should be the discount rate which is to be used for calculating the free cash flow or discounting the future cash flow at this particular rate. We try to have certain assumptions where sometimes we consider the industry rate, industry growth rate to be the thing. Sometimes you can also put into the factor interest rate prevailing in the market, right? Sometimes you can also consider the industry rate, interest rate, and in certain cases the bank rate could be considered. So any of these things. So you can have base as this, and then you can determine what should be the discount rate. Understand that the higher the discount rate, the lower would be the valuation. Why? Because the future cash flow is 10 rupees, and if suppose I'm discounting it at 10 rupees, then probably the today's rate might be calculating the value of equity using free cash flow. The first step is to project future cash flow. So you should project future cash flow. So this is just a forecasting, right? Forecasting for either 5 to 10 years. And how do I forecast? It's based on the previous data which is available plus the market conditions, whether I assume growth rate or whatever it is. So that is the first condition. So I should have a forecast period, that is previous till what time I have to take, that is based on that. Last 5 years has been considered to be a period in which no untoward incident has happened. So I consider this as to be the best period, and with the growth assumptions, I am going to put the projected future cash flows. Okay, the second step which is involved in calculating it is to calculate the discount rate. So in the previous slide, I told you we can either use a weighted average cost of capital for free cash flow to firm and cost of equity for free cash flow to equity. So why we are using this is because this is considered to be the expected rate of return by the investors. So the third step in the calculation of free cash flow is to discount the free cash flow to present value. So why do we discount it? Because as I told you earlier, the money in your hand today is more valuable than your money tomorrow. So it is discounted to determine its present value, and in case of free cash flow to firms, the sum discounted is nothing but the free cash flow values and subtract the net debt and to find the equity value. I'll take once more. That is the third step is to discount the free cash flow to present value. So how do I do it? I've already determined the discount rate, whether it is weighted average cost of capital or cost of equity. So discount rate is determined, and after determining the discount rate, I have found out the present value of the free cash flow. In case of free cash flow to the firm, then the sum discounted is including the debt portion, so that I can find the value which is available to equity shareholders. So the free cash flow will not include the debt portion. I'm going to deduct it from this so that I can find out what will be the value to equity shareholders. Otherwise, in total, if suppose I'm going to say what is free cash flow to firm, it includes the money which is available to both debt as well as equity shareholders. But once I do the deduction from the free cash flow, then the amount available will be for equity shareholders. So this is necessary to find out the value of equity after paying out the debt. And the last step what you have is to sum the discounted cash flow after adjusting the debt in free cash flow for firms. Okay, so here the free cash flow for firms, I'm trying to find the value of equity by summing up the present value of free cash flow and subtracting the net debt. That is what I've told already over here, right? And in terms of free cash flow for equity shareholders, it is simply the total of the present value which would be given to equity shareholders directly. So understand one thing, that there are two concepts of free cash flow. One is for the firm and the other one is for the equity shareholders. For the firm, when I'm talking, this money is equally applicable to both debt holders as well as equity shareholders. Whereas when I'm talking about equity, this is only available to equity shareholders and not to debt. So for the firm, when I'm talking, it says the firm's capital is made up of both debt amount as well as equity amount, and that is the reason why we need to subtract the net debt from the overall thing, so that I can find out what is the free flow cash flow for the firm. Okay, and with this I have tried to make you understand the concept of free cash flow, how it is being calculated, what are the situations under which discounting has to be done, and the discounting rate, how it is identified for free cash flow to firms as well as free cash flow to equity shareholders. Both the things I have discussed. Problems, we'll take it up, time permits. Otherwise, theoretically, I think you should be able to understand the basics of it. Thank you.